Good morning, traders. It is Tuesday, the 26th of May, 2015. It's 8 a.m. Chicago time. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. A quick rundown of the news that's driven the overnight session. I want to point out that, in case you didn't know, yesterday was Memorial Day, the Memorial Day holiday here in the U.S., and as such, I have removed that data from my charts. So my charts and volume profiles do not reflect the session between Sunday night at 5 p.m. Central Time, Chicago time, all the way through to noon on Memorial Day. That data is not in my charts. If you're using Investor RT, all you need to do is right-click in a blank area of your chart, go down to Scrub Data, and remove holidays, and that should take care of it. You have to do that for every product. News overnight: the Shanghai Composite Index continues its bull run. It's up over 12% over the last 6 sessions, the best run since November of 2008. We all remember what November 2008 looked like. Little progress is seen in the Greece bailout talks. Greek yields jumped up over 200 bips on the 2 years. Just massive swings in there. Greek yields moving higher as deadline looms, and Greece is unlikely to make payment to the IMF by the deadline. There's some conflict with that last statement. Their finance minister keeps saying it, and then other people within the Greek government keep coming out and saying that's not the case. But who knows? The U.S. dollar index, I'll show you a chart of the U.S. dollar here shortly, hits 1-month highs as the markets react to Fed Yellen's comments from Friday that the rate hike is still on the table for 2015. The market's starting to price that in September. Over the weekend, Fed's Fisher, who's a voter, said that he sees an argument for publishing the Fed's rate path forecast, but says that if they do so, the market must understand that the Fed has no obligation to stick to it. And also, Fed's Mester, a non-voting hawk, said the time is near for a rate hike. That's further pushing the U.S. dollar higher. The dollar's has retraced approximately 50% of its drop from mid-April. Again, I'll show you that chart. And then at 7:30, just a half hour ago, we got U.S. April durable goods orders, negative 0.5% in line, durable X transportation, 0.5 positive versus 0.3 expected. Durable goods, you might want to note, durable goods are coming in weak despite the fact that they've been revised higher pretty aggressively. Some of the revisions on durable goods have been fairly substantial. For example, the second revision from last month on durable goods was moved higher from negative 4.7% to positive 5.1%. That's quite a swing. And across the board, the numbers moved higher, 0.3 to 0.6 X transports and so on, yet they remain weak. It's just another little clue there. Let's look ahead at what's on deck. And by the way, we just got the Case-Shiller, the March S&P Case-Shiller City month-on-month index coming in at 0.95% versus 0.9 expected, so slightly better. Year-on-year, 5.04% versus 4.6. And then we also got the March FHFA House Price Index, 0.3 versus 0.7. Those just came out at the start of the broadcast. Looking ahead today, we have the U.S. Composite PMI at 845. Services PMI also at 845. Those are all times are central. That's 15 minutes after the open. At 9 o'clock today, we get new home sales of 500,000. And consumer confidence index, the consumer confidence index, also at 9 o'clock, looking for 95.2. And then Richmond Fed looking for 0, also at 9. And that's pretty much it. The Fed discount rate minutes at 1 o'clock today. I'll be looking out for that. As far as speakers, there really isn't anybody on deck worth talking about. And a fair amount of auctions. We have 3 and 6 month T-bills as usual, and then we have a 26 billion 2-year bond auction at noon. Note also that the silver June options, gold June options expire today, as well as heating oil, RBOB, and Henry Hub natural gas, all expiring today. So if you're in those markets, you'll probably want to bail. Let's look at the overall. Oh, and by the way, since it's the first day of the week, let's take a quick look at what to expect for the rest of the week. Tomorrow we have the Bank of Japan April 30th meeting minutes, US API crude oil. We will not get the DOE crude oil tomorrow because of the holiday. Fed's Lacker and ECB's Draghi to speak tomorrow. Thursday, U.S. jobs report, pending home sales, natural gas, crude oil inventories, Fed's Williams, and ECB's Nowotny, as well as Fed's Kosher Lakota. Friday, the Japanese jobless rate, UK GDP, US GDP annualized, and Chicago PMI on Friday. Fair amount of numbers, nothing of primary importance, though. Got to pay attention to what the ECB says, though. Here's a look at the charts. Let's backtrack a little bit, just so we can put the story in perspective. We're still battling since the February balance. It's just a wide balance, but we keep pushing it wider. It's now only 100 points over the last 3 months. 100 points covered over the last 3 months. Remember, the average weekly range is approximately, not average, but the normal weekly range is approximately 30 to 54 points. And we're just, because we're trading back and forth, we're not extending this balance range very much. We've had complete balance over the last few sessions. The whole week last week was completely in balance. Monday broke out to new highs, and we kept making highs to 21.32 and a quarter, but overall the market's stuck in a balanced environment. So what we need to do is draw an MC or a microcomposite around those to look in the short term where we are, which is what this is here. From Monday onwards, we're looking at the balance, and that's where the market is stuck. On Friday, we basically closed right at the point of control of this balance zone. Pretty tight market. We've traded mostly on the positive side, or on the top side of this balance zone. You could see here the black line is the most traded price. I'm still looking for a test of 21.16, which we got overnight. Remember, 21.16, 21.15 quarter were the targets below. That's what I was looking for on Friday, looking for the market to actually test up and then rotate down into 21.15 and a quarter. Right here, this is the naked point of control from the 15th, and that's where the overnight low is on the dot. Again, not a coincidence. Below there, looking for 21.13 and a quarter, and then 21.10 as the next areas to test out, and then we move into this bigger balance zone and start looking at 2100 and so on and so forth, with 2094 being the most valuable price in that area. So we're working our way away from the zone that we built, the high volume area that we built, the acceptance that we built up here we're working our way down. This is the LVN. This 2120 is going to be important today, and we're working our way down and into other higher volume areas. And the next big volumes are going to be at 2100, 2101, and then of course down into the 95, 50, 94 area. So that's what it looks like. Again, if you listen to the Trader Bite on Friday, the plan for Friday was for it to, we could see that it was opening in range and on the edge of value. The expectation is for responsive buying back up to this 28, potentially 28.75 to close the gap and the naked point of control, and then for it to rotate down and push through. And that's basically what we got on Friday, but unfortunately, this failed here. This was just a beautiful way to test here. It was basically the only opportunity I saw on Friday that was premeditated or pre-planned. The test and failure at 28.75 to 28.50. Then it rotated back into the opening swing down towards the IB low. This looked almost like a double IB low, and it was a double IB low. So the expectation was for this to break with a fairly decent probability, and then we would finally test 21.19.50 next and start working towards 16.15 quarter, and then 2100. I was hoping for that, especially going into the holiday weekend, that some folks would want to balance their risk and take some positions off and cause this rotation. But instead, it went to the IB low, chopped in the middle, and then it got this fairly decent rotation up to continue to break the IB high, chop, 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 and then we finally break that IB low, double IB low, and get the the stat, and then we close basically at 21.24.50, and then from there. So what we had on Friday is a primary hypothesis that was that just did not play out completely. From there, we basically reopen after Sunday's session, reopen with a gap down, test back up to where we closed on the tick, 21.24.50. That's where we closed Friday on the tick. And then the European market opens, and given the news and the fact that there was a fair amount of movement, bunds are up, DAX is weak, US dollar stronger, euros weaker. The overall sentiment was to sell, and we had some strong selling right at the European Open, which was taken back a little bit, but overall strong selling remains. We have a double distribution profile overnight. Volume's fairly decent at 159,000 so far. And it looks weak to me. This low is very, very weak. And my outlook for today, my primary hypothesis for today is for the market to likely attempt to rotate back up towards 21.21, and then I'm looking for sellers to step in. If I don't see sellers stepping in, it would be troublesome for shorts here, as the next target's likely to be 24.50 for the overnight stat and the gap close, and then 21.27 to bring us back into value. But what I'm looking for is resistance at 21.21, and then a rotation, and then for this to roll over and start taking out 21.15 and a quarter to give us the overnight stat, push through to 13 as the next target, and then start working its way down to 21.10, which is only 7 points away. The key target below, again, is down in this 94.50, 95.50, 94.50 area is the key target, and that's about that's a decent target for a selling day. So remember, we're moving out of balance. If you look here, we have pretty decent kurtosis, or the layman term, maybe fatness or bulginess to this profile. There are only 3.73 million contracts that were traded in all of these days, 5 days, and only 3.73 million contracts. Remember, the S&P mini on a day session, the most prevalent number of contracts per day is approximately 1 million, with 1.6 being on the high end of normal. So not very much, not much traded. We had 626 on Friday, 626,000, 669,000 on Thursday, 869,000, and so on and so forth. So on average, we were under 800,000 contracts per day. So as much as I'd like to believe that this is quite a bit of coiling here, and it looks like it is, there wasn't all that much volume. But the reason this is important is because when the market's in balance, and you have a profile that's very, very thick and has a very sharp kurtosis, that is really good fuel for an imbalanced condition or a trending condition. I'm looking for it to drop, and that's my primary assessment. So open, attempt to regain value. 2121 being the over underline or the cutoff point, which is also around the overnight point of control. And the expectation is for it to roll over, drop to 2115, and then start testing 2100, and then work itself down to 95.15, 94.50 as the target. Does that make sense? So that's the big picture. U.S. dollar. Here's your U.S. dollar index. A nice W formation that the skewed down W formation that failed, and then we have a drop that caused the euro to push up recently, and then now it's coming back. And from the last swing where the energy came from, here we have an impulsive move and a continuation or extension here. And it's come back to about 50%, and you can see the dollar's seen a fair amount of strength here. So if we look at Friday, here are Yellen's comments and expectations that the market was forecasting, and it's continuing to get stronger. This means that it's putting a lot of, as the dollar gets stronger, dollar-denominated commodities drop in price because the commodity is still the same. Like crude oil, still crude oil, except if the dollar's more expensive, the value of crude oil is going to be affected. There's a correlation there, and therefore you could see it here in crude oil. Crude oil, my big picture outlook on a high time frame was for it to balance out, maybe pull back a little bit, but I was looking for crude oil to turn up and take out the 63.54 area and start working itself up to 65 and up the thin volume zone. But it just cannot find its buyers, and now it's moved into this lower balance area, which has a point of control of 58, 5808, 5809, and it's getting very close. So crude oil has been selling, and I know a lot of it's a reaction to the U.S. dollar, but it is what it is. It's not playing out as expected. Here's the Bund. The Bund has had an impulsive move, has not seen a corrective continuation move yet. And is getting a little bit stronger because of the Greek situation. This chart looks almost the same as the 10 years. Here are the 10 years. The 10 years are basically in balance, forming a triangle here. And the expectation on the 10 years is to continue this move lower. Again, I'm expecting the 10 years to drop. And of course, if the market starts to continue to speculate on interest rates coming up in September, then we expect yields to increase, and therefore the price of the notes to drop somewhat for the yield curve to adjust to what's expected. Anyway, I might have lost you and all that. But overall, that's the expectation. If you have questions or comments or anything, you can get a hold of me on futuretrader71.com/contact. Otherwise, I wish you the best of luck. Remember, this is a probability-based game. You're balancing probabilities with risk. So it's great that you can get in and trade, and it's easy to enter and exit the market through your platform. But if you're not balancing your probabilities with the risk you're taking to play out those probabilities, then you're not a trader, you're a gambler. Remember that. Good luck to you. Take care.